Credit cards, everyone uses them, but very few people truly understand how they work. In this video, we're breaking down what credit cards are, how they work, how interest really grows, and how to use them the smart way without falling into debt. If you want to take control of your money, build strong credit, and avoid common financial mistakes, you're in the right place. Make sure to like this video because it helps the channel reach more people who want to learn about money, and subscribe to Mano Invest for simple, practical explanations of investing, credit, and personal finance. Now let's get started. What is a credit card? A credit card is a financial tool that lets you buy things using the bank's money instead of your own, with the agreement that you'll pay the bank back later. When you use a credit card, you are borrowing money. You're not spending money you already have. You're spending money you promised to repay. This is why it's called credit. The bank is extending trust to you. How credit cards work. When you swipe, tap, or enter your credit card online, several things happen behind the scenes. The store sends the charge to the credit card network. Your bank approves the purchase. The bank pays the store for you. The amount is added to your credit card balance. At the end of your billing cycle, the bank sends you a statement showing how much you spent. The minimum payment due, the due date. You usually have about 25-30 days to pay. If you pay the full balance on time, you do not pay interest. If you don't, the bank begins charging interest on what you owe. What is a credit limit? Every credit card comes with a credit limit. This is the maximum amount the bank allows you to borrow. For example, credit limit, $1,000. You spend $300. Available credit left, $700. Beginners often start with lower limits. As you prove you can manage credit responsibly, banks may increase your limit over time. How do you get a credit card? Banks don't give credit cards to everyone automatically. They want to know how risky it is to lend you money. They use your credit history to decide this. Your credit history includes whether you've borrowed money before, whether you paid it back, whether you paid on time. All of this information is summarized into a credit score. What is a credit score? A credit score is a number that represents how reliable you are as a borrower. Higher score equals lower risk. Lower score equals higher risk. In the United States, 740 plus is considered very good. 800 plus is excellent. Below 580 is considered poor. Your credit score affects whether you get approved, your interest rate, your credit limit, the types of cards you qualify for. Why do people use credit cards? If it's borrowed money, why use them at all? 1. Convenience. You don't need cash and can pay anywhere, online or in person. 2. Building credit. Using credit cards responsibly helps you qualify for car loans, mortgages, business loans, better financial opportunities. 3. Emergencies. Unexpected expenses can happen, and credit cards provide short-term flexibility. 4. Security. If your card is stolen or used fraudulently, your bank investigates. You usually aren't responsible for fraudulent charges. This is safer than losing cash or debit funds. 5. Rewards. Many credit cards offer cashback, travel points, airline miles, discounts or perks. Some cards also offer sign-up bonuses if you spend a certain amount in the first few months. Types of credit cards. There are many types of credit cards, including cashback cards, travel rewards cards, student cards, secured credit cards, premium cards with annual fees and luxury perks. The best card depends on how you spend money and your financial goals. What is interest? Interest is the cost of borrowing money. It's expressed as a percentage, called the APR, annual percentage rate. Example, you owe $1,000. Annual percentage rate is 20%. If you don't pay the balance, the bank charges interest on that amount. Interest only applies if you don't pay the full balance by the due date. You carry a balance month to month. Compound interest. Credit card interest is usually compound interest. This means interest is charged on your balance. Then interest is charged on the new balance. This repeats every month. Even small balances can grow quickly if ignored. Paying only the minimum payment keeps you out of late fees, but most of your money goes toward interest instead of reducing the original debt. Fees to watch out for. Depending on the card, you may see annual fees, late payment fees, cash advance fees, foreign transaction fees, balance transfer fees. Always read the card's terms before applying. Smart credit card rules. This is not financial advice, but widely accepted best practices include credit cards are not free money. Always know your APR. Only spend what you can pay off within the month. Try to use less than 30% of your credit limit. Track your spending. Set payment reminders. Pay your balance in full whenever possible. Used responsibly, credit cards can be powerful tools. Used carelessly, they can lead to long-term debt. Finally, a credit card lets you borrow money, build credit, earn rewards, pay securely, but it requires discipline, planning, and awareness. The card itself isn't dangerous. How you use it determines the outcome. If this video helped you understand credit cards better, hit the like button. It lets us know you found value in this breakdown. Subscribe to Mano Invest for more videos on credit cards, investing, saving, and building long-term wealth.